All right. Good afternoon, everybody. Welcome to Freedom Deals Live. I forget which week we are now, but we are in September and we're going to be doing things a little bit differently. So, for those of you that haven't joined us before, what I normally do on these sessions is we go through a specific deal, a deal that I've either got that is live uh, or that we are going through the due diligence process currently, or a deal that I've done in the past. And we look at that deal through the lens of actually doing the due diligence live together. And the idea being to have you flex that muscle. It's kind of like going to the gym where you get to do that repetition over and over again, which is one of the things that when I started out on this journey was one of the most challenging things. And I find out in the marketplace is one of the things where people mostly run into trouble because if they don't have someone experienced looking over their shoulder, which typically costs you tens of thousands of dollars per year to have I guess that luxury, then you've got very limited ability to actually learn these due diligence skills under the supervision of someone else. So while this isn't quite under the supervision, the idea is to help you flex that muscle and build that skill set. That being said, today we're going to be doing something a bit different. And I actually should do a tech check first. So I can see a few of you are online already. Can you just pop in the comments confirming you can see me and you can hear me? So there's no screen share at the moment. It is just me talking with a curtain behind me. So yeah, if you can pop in the comments that you can see and you can hear, that would be much appreciated. That way I know I'm not talking to myself. But I will continue anyway. So why I'm doing this today. So what we're doing today is I want this to be more of a discussion. Thanks, Rachel. I want this to be more of a discussion, and I want you, and I'm just going to pop you in full screen actually. Bear with me. There we go. I want this to be more of a discussion, more of a workshop. So rather than me talking to you and just lecturing you, I want this to be discussion. I want this to be question. I want this to be you challenging yourself. And I want you to be looking at this from perspective of you've got a live deal. Because the danger of this is I do this for free, mostly, these sessions. And it's very easy to just turn up to them and go, oh, well, there'll be another one next week. Well, first of all, there may not be another one next week. I mean, I am doing it for free. So there's no guarantee there will be one next week. But to put some numbers to it, and this, I think you should think of it this way, is to do this kind of a session with me one-on-one for half an hour to an hour. In the marketplace, people pay me about $2,000 for that ability. So I would suggest you approach these sessions like you paid $2,000 to be here. If you go about it with that mindset, you're going to get a lot more out of them rather than just taking it for granted because it turns up each week. Now, the other part of that too being is if you just take this as information going one way, as in I'm just telling you stuff, again, you're not really going to get very far with that. And this is something I say on a very regular basis is your financial intelligence goes up when the money goes hard. So when you start getting deals under contract, you will find that your financial intelligence goes through the roof because all of a sudden you need to shift gears. It's a complete mental shift. You go from this place of, oh, I'm just learning, I'm absorbing information. Well, absorbing information doesn't really teach you much. Like, yes, it's kind of like school. You get to remember the information, but that's not really, I'm going to say it's not really education. Obviously, take that for what it is in terms of the wording, but you only start when you start learning how to use that information, start learning how to apply that information to get your results, to create influence, to create results. Now you're educated. It's the usual thing. If you don't know how to explain it to someone else, you don't really understand. And if you don't know how to apply this information, there's no point knowing it. When you're just in this situation with me where I'm telling you and you're listening, that's kind of where that's at. It's not two-way. Whereas as soon as you get deals under contract, your mind has to switch into, okay, how do I deal with this? What else do I need to think of? What are the things I don't know, I don't even know yet? How am I going to solve these problems? How am I going to come up with the money for this deal? How am I going to de-risk this deal? All of that is a complete shift. And that is where your education really begins. So why are we doing this today where we're going to be looking at, okay, how do you have unlimited deals? How do you fund unlimited deals? And there's the hint in that it's about raising capital. And this has really just become so acutely obvious to me again in the past couple of weeks with what I've been working on. So I'm currently in a hotel room down in Victoria at the moment. And I've been spending a lot of time down here over the last couple of weeks, all related to one specific thing. I'll look forward to sharing those things in the future. But none of this would be possible for me right now if I had not been honing the skills of raising capital. Raising capital, even when you start out, it might be 10,000, it might be 20,000, it might be 100, it might be half a mil, whatever it is, it doesn't matter. But the point is, and Robert Kiyosaki said the same thing, learning how to raise capital is one of the most important things when it comes to your wealth creation journey. And there's so much tied into that. The ability to influence people, the ability to have people put faith in you to get a result. And to boil it back to one thing, it comes down to integrity. And I did a bit about this on a podcast I was on a while ago. Is one of the things I've seen happen when it comes to raising capital and doing deals is people that haven't necessarily been their word up until that point, and now they want to go and raise money, and they have trouble doing it because people don't know them as someone that is their word. They say one thing, they do something else. So if you're a person that says one thing and does something else, then the likelihood of people being able to or being willing to trust you with capital is very limited. And the thing is, it comes down to your track record. You can't expect that if up until today you have not been your word, that all of a sudden you go to someone, and this is like what I'm teaching my kids at the moment is, if you tell me a fib over here or you don't follow through on what you say you're going to do over here, then in cleaning your room, then if you want to go use the mower, oh, I'm not going to trust you. That's life threatening potentially. If you can't follow my instructions over here, then I can't trust you over here. These two things aren't separate because it's just about being your word and having integrity. And the same is with capital raising. If you are known as a person that is your word and will follow through, and not just what's on the paper, but as in the spirit of the agreement, seeing yourself as a true custodian of people's money and their wealth and the trust and the obligation, and I guess the honor of it as well. If you act like that person, attracting capital to yourself will become relatively easy. If you are not that way, then good luck to you. So that's the first lesson in that. But I'm going to dial that right back because now I'm obviously talking about, okay, I'm dealing with some things that are certainly way beyond what I would have dealt in my first couple of years of doing deals. But the skills that I've learned over the past, whatever it is, 10 plus years of doing deals and raising capital, that is now what is making these opportunities available to me. I would not have been able to take advantage of these necessarily at the beginning. So it's this gym all the way through. It's always a learning journey. So my question to you is, let's pretend that we take one of the previous deals that we've looked at. It's a 1 into 2. So it's let's call it a standard 810 square meter block. And the idea is that we're going to bulldoze that house and do a 1 into 2 subdivision, and we're going to sell the vacant land. Now, let's skip past the due diligence process for the moment and pretend that this is a deal that we've already done on this. I've vetted it, and let's even say I'm giving you a guarantee. Or not, no, we'll take that part out. That takes away from some of it. But I've vetted it with you, and we've agreed that this deal is a goer. It's over 20% ROI. There's, say, $400,000 in profit, but you have no money. You do not have the ability to fund this deal. But you have now an ability. You have now a deal. You've identified an opportunity. This is a real deal. This is 123 ABC Street in Kedron. $400,000 worth of profit. You've got it under contract, but you have no money and you have no ability to borrow. Let's start there. Now, I really want you to put yourself in these shoes. This is real for you right now. Now, what do you do? I want to see this in the comments. Unfortunately, I can't get you to share screen on this platform. To do video on this and have a chat. That would have been ideal. But start putting in the comments, how would you fund that deal? Let's actually work our way through this like this is a real deal for you. So it's a 1 into 2 subdivision. There's an existing house on it. You need to fund this deal. All right. There's $400,000 worth of profit on the table. I'd imagine that would make a difference to your life. You need to make this happen. How are you going to fund that deal? So start popping this in the comments. And if you've got questions as to to figure out things, that's fine. But I want you to start working through the process here. All right. Obviously, to buy this property, there's cash needed because cash is needed for at the very least the deposit. And I presume there's going to be debt needed to borrow to fund the rest of the project. And then there's also going to be cash needed or debt to fund the construction of it. So how would you go about it? And if you're sitting there going, I have no idea, start with questions. Like I said, pretend that this is a real live thing. This is landed in your lap. You either make this work or you sacrifice the deal and it's gone. This opportunity to make 400,000 in total, some might be going to an investor. So even if it's a 50-50 proposition, $200,000. There's an opportunity here for you to make at least $200,000, up to $400,000, depending on the split, so long as you can fund this deal. Okay, so we've got Rachel starting. Good, thank you, Rachel. All right, private lending with higher rates and or speak to people you know. JV with someone else. Okay, good, we've got somewhere to start. Okay, so that has taken, let's say we've got the private money lender, and it could also be a bank or a tier 2 lender or many of the others. So let's assume that we're going to use one of those, a private money lender or a first or second tier lender, for the debt component. Okay, so let's put some numbers to this. Let's say it's don't get caught up on how this tees up as an ROI based on the profit I just said, but let's say it's a $1 million purchase. And so we're going to need, let's say it's a 20% deposit. We're going to need $200,000 for the deposit. And we're going to need, let's say, 300,000 to do the rest of the project. So in total, we're needing 500,000 in cash, and we're needing 800,000 in debt. Okay, so the 800,000 in debt is coming from a private money lender, or it's coming from a lender. Now, this is your first project, so you have no track record in terms of performance as a developer. So maybe the private money lender will lend it to you, but maybe they will not, because there's no track record. Now, truth be told, they probably will. And the reason I say that is, and this is, no offense to the good ones out there, but there's plenty of sharks in the private money lending world who are happy to lend you the money so long as they've got the security, because they're more than happy to rip it out from underneath you. So got to be real about that world too. But okay, so we can probably get the 800,000. Now let's still start there. How would you go about that? How are you going to get the $800,000 worth of debt? Talk me through the actual steps. So it's conceptual at the moment. What would you actually do? Who would you actually talk to? Speak to someone you know who has done it before. Profit share. Okay, so as in, going to another developer, so like myself or someone else like me that has done deals before, doing a profit split with them. Okay, I'm not going to make it too easy for you. So I'm going to put this to you and go, well, if I'm the one bringing the IP, so this is like if you came to me and I'm sort of trying to play devil's advocate here. So if you bring me a deal and what your contribution is that you're bringing the deal to me, but you're relying on my expertise to fund it and to run the deal as well, or at the very least tell you step by step how to run the deal, then that's a possibility. However, how much do you think you're going to need to give up of that deal to have that proposition work? Because if your only contribution is bringing the deal, in effect, you kind of become the buyer's agent there. It's like you're a deal finder. So, typically in the market, that's more of a, oh, look, okay, if your contribution is bringing me the deal, I give you a deal finder's fee, might be anywhere between 1% to 3% or something like that. And then basically, if I'm the one funding it, or I've still got to find people to fund, or I'm the one running it, then the rest is on the table for me. So that's an option, but it's the option that's going to pay you the least, and you're going to get the least learnings out of it. Because if you're not the one actually doing the deal, then you're still sort of back in that same place. Okay, good on you, you found one, but you haven't really progressed on your journey. So let's take that option off the table. Not to say you can't do the deal with someone that has experience, but let's take that option off the table where you're partnering with someone and relying on their expertise to actually perform the deal. So still on the table for a joint venture, that's still an option. But one of the things I would say too is when you're doing your first joint venture, if that's the way you went, something to consider is that if you are the one bringing the deal and your outcome for yourself is to become an expert in this space and to build your skills as a developer, piggybacking off someone else, shadowing someone else is not the best way to do that. That's a way to learn. But once you get your first deal, the best way for you to learn it is for you to be the doing, you to be the one actually running the deal, fine, have someone overlooking that you can defer to, that you can refer to and go to for guidance, but don't have them running it. When you're just the one watching, there's limited value in that. So you want it to be a case where you're the one doing it. And there's a risk associated with you being the newbie and joint venturing with someone that has experience, because the likelihood is that they are always going to want to be in control. It's a likelihood. And even if they don't want to be in control, the dynamic there is, you are the minority. When really, when you are the one running the deal, it's not really a great situation if you're putting yourself in a position where, in theory, you're wanting to be the one in charge, but ultimately in the dynamic between the two of you, you're sort of junior to them. So I recommend surrounding yourself with people that are more experienced than you. The dynamic of going into doing a deal with someone more experienced with you, I'm not saying don't do it, but it's something you do need to be careful of, because ultimately you're going into a deal where someone is smarter than you. So if they have integrity, okay, that'll work out fine. But if they don't have integrity or not necessarily aligned with your outcomes, then you're kind of at their mercy, because they are more experienced and they, in that space, are smarter than you. So you just got to be aware of that. Okay, so what else? Now, Rachel's the only one talking so far. No one else in the comments. Help me out here. So, you don't help me out, help you out. How are you funding this deal? There's 400 grand on the table. You need 800,000 of debt. You need $500,000 in cash. All right. So what else? We're still very high level here, just going, oh, I'll get a money partner. How's it getting structured? How are they getting security? What are you offering them? What's the documentation? What time frame do they have? How are you managing who's in control? How are you managing who's got final say? Do you have equal say, or is there a superior vote? Can someone have veto? I want us to actually get into the nuts and bolts of this, as in, how are you actually doing this? Not just high level. Oh, I'll get a money partner. Okay, how's that going to look? Okay, so yep, $500,000. Let's stick with the debt for the moment. You need 800,000 in debt. How are you getting it? Be specific here. The more specific here, the more you challenge yourself to actually come up with this. Like, this is a real life thing. If I wasn't here, what are you doing? How are you getting that money? You have no ability to borrow. So how are you going to get that debt? Other than ideally going to a private money lender and signing your firstborn child over. Come on, guys, dig deep here. And it's okay to say, I actually just don't know. I've got no idea. Or if you're stuck on something, tell me what you're stuck on. This is where we can actually get some real ground, shifting here. What are you stuck on? Because if you're sitting there silent, you're either disengaged in the conversation, or you're afraid to put out whatever it is you're thinking, or you're hoping someone else is going to do the heavy lifting for you, like Rachel right now is doing in the comments. My question to you is, how's that going to work out for you out there in the marketplace? All right. If you're real about this, if you're serious about this, I don't know any other opportunity you're going to get to sit down with someone who's done this countless times, who's actually going to give you this kind of a challenge and have this kind of level of conversation with you. Evelyn, excellent. A JV money partner and an investor with some money. Okay, yeah, but remember, we're getting more specific here. How? What are you doing? Who are you calling? Who are you talking to? What does it look like? So dig deeper. What's next? Okay, so let's say, we go, yep, okay, that's the way we're going to do it. A JV money partner and an investor with some money. So the JV money partner, I'm guessing the joint venture partner is getting the debt. But again, how's that happening? How's that going to work? Why would they go and get debt for you? Remember, it's okay to say no and tell me the parts you don't understand, because then I can fill in the gap. But at the moment, we're still very this is the stuff that gets put up on slides at the free event. Yep. Okay. Cool. So we've got a joint venture partner that's going to get the debt, but why are they getting debt for you? What's their? They'll be on the title. Okay. Now we're getting somewhere. Good. Okay. So they are going to be on the title. So they're going to be the owner. Okay. So let's take that a little bit further. So you're going to get a joint venture partner. There's obviously going to be a joint venture agreement there, and Evelyn is suggesting that they will be on title. So if it's an SPV, like a special purpose vehicle, a company or something like that, they are going to be the director. Is that what you're saying? So they will be the director of the company that owns the project. Is that what you're saying, Evelyn? And noting Rachel there, go through your phone book and just ask. Someone may have money, even if it doesn't look like it from the outside. Yep, 100% Rachel. That's definitely a way to start. Okay, but I think we're getting more on the track there with the line of questioning now that Evelyn's throwing out there. Like we're getting specifics. Okay, so we're talking security for that joint venture partner for the debt. Okay, but again, name on title. Is it their personal name on title? Are they owning it in their own name? Or is it a special purpose vehicle and they're the director of that? If they are a director of that, yep, correct. Yeah. So they do need to be on title in one way, shape, or form to service the loan or to get the bank debt. Okay. But now if they are the sole director, because the thing is, if you are the director as well, then you come into the servicing mix as well. Because if there's two directors, the bank's going to want to know the financials for both. Okay. And that's maybe not great because if you don't have any serviceability, but B, you don't want to be on the loan because if you go to a loan for a loan later on, the bank is now looking at this one as well, all of that debt is yours as well. They don't go, oh, it's 50-50 or it's 90-10. They go, well, your name's associated with that application. So all of that debt's yours too. So how are you maintaining control if you're not on title? This is good. We're getting somewhere. You can't be on the title because you don't have the serviceability. Correct. Mostly. How are you maintaining control? So how are you going to be in control of this deal if you don't own the property and if you're not on title? Are you just going to trust the joint venture partner to do the right thing? JV agreement. Okay, cool. So JV agreement is going to stipulate that they are going to be on title or they're going to be the director of the company. Who owns the company? Do they own 100% of the shares or is it a 50-50 split of the shares? So you got who's control of the entity. That's what you need for serviceability. What about ownership? Who owns the shares? Okay, for those joining, we are actually workshopping how the nuts and bolts of how you're going to fund this deal. That is 400,000 in profit on the table. You need $500,000 in cash. You need $800,000 of debt. Okay, so a caveat. Yeah. Number one, there's limits to how long caveats can stay on title, and you can't just lodge them willy-nilly. Number two, it's pretty broad. It's so it doesn't say to anything to like who's making the shots, who's making the decisions. 50-50 for the structure, so 50-50 ownership of the structure. Okay. All right. I'm the investor. I've never dealt with you before. And I know that this is your first project and I know you don't have a track record. So me as the investor, I'm on for 100% of the debt. So I'm signing up for $800,000 worth of debt, but I'm only a 50% shareholder of the company that owns the property. The property's worth $1 million. So I'm only getting $500,000 worth of security for the $800,000 worth of debt that I've just signed up for. Uh-oh, what now? Rachel, speak to the solicitor to formalize the agreement. Yeah, that's true, but these are the questions that he's going to be asking or she's going to be asking you. So that's what we're trying to get through is actually trying to wade through all of those things that sit in the background that until you do one, no one thinks of. But this is the actual nuts and bolts. These are the discussions that you actually need to have with your investors. Yeah, but see, this is good. This is good. All right, we're getting somewhere here. That's the whole point. Because the thing is, whether you're aware of it or not, if you have mostly spent your time going to free seminars, reading books, and even doing a 3-day course, those sorts of things. These sorts of things are typically not talked about there. That's like this is further down the road. This is when the rubber hits the road. So this is all the stuff that sits in the world of you don't know yet. and we're just scraping the surface. And again, this is why I say getting deals under contract and actually getting on the road is so important, because that's when you learn this stuff. That's when all of this stuff comes up. And you might be going, well, shit, I don't know. I can't go get something under contract because I don't know the answer. The thing is, you never find out the answer to a question you didn't know to ask in the first place. All right, so this is good. Good on you. Okay, let's keep going. What are we doing? Okay, I'm your investor, and I'm going, you want me to sign up for $800,000 worth of debt, but I only own half the company. So I'm only getting $500,000 worth of security, but I'm signing up for $800,000 in debt. Explain to me how my investment is secure. How is that a good commercial decision for me? So you've either got to talk me around on that, or you've got to come up with an alternative. So we're going to skip the talking around because you don't really have the ability to talk me around on this right now. So what's the alternative? So the truth is, you may get that across the line. If there is enough trust between the joint venture, you may get that across the line. However, what you need to remember too is most joint venture partners are going to go to their solicitor, and their solicitor is going to review the agreement. So even though you might have talked through these things, I can guarantee you no solicitor is going to advise their client to sign that piece of paper if the math says you're signing up for $800,000 worth of liability, but only $500,000 worth of security. So like I said, I'm not saying some won't sign it, but just be aware that that will be the guidance, that will be the advice that they receive from their solicitor is do not sign that paper. If you are signing up for 100% of the liability, then you need security for that. Okay, what are the alternatives? Let's pretend they've now had this advice from their solicitor and it's a hard no from them. They're like, yeah, look, I love the deal. You seem like a person I want to deal with, but I can't. Yeah, I'm new to this too. This is, I'm talking as the investor. I'm new to this too. I need to take the advice of my solicitor. And my solicitor is saying that I'm nuts to sign up for 800,000 worth of debt, but only $500,000 worth of security. Give them the fees and show them that you have researched it thoroughly. But so what? That profit comes later. As in, you've got to generate the profit, and I'm relying on you to deliver that profit, and there's no track record yet. But even if there was a track record for the start of that project, the moment I sign up, the moment that settlement happens, I'm in the red. I've got $500,000 worth of security. So if everything goes to hell and that property gets fire saled, my best case scenario is getting 500 grand back, but I'm signed up for $800,000 worth of debt. Couldn't you have another money partner for the cash as well? It would be a silent partner and not a JV partner. Yeah, but that doesn't answer our issue here with the debt first. So we will get to the cash partner, okay? And it could be the same person, but at this point, we're still stuck. I'm your investor, and like this is real conversation. This is hypothetical, unlikely to happen. This is very likely what the conversation will be. If they take the agreement to their solicitor with what we're on so far, you've got a bugger all chance of getting them to sign it, unless there is a tremendous amount of trust there already, because that is truly what they're signing up for in that arrangement is 800,000 worth of debt, 500,000 worth of security. They exposed $300,000. They just get a percentage at the end of the deal. Yeah, I get that. So the fee zone might look good. The fee zone might look good. It doesn't change that their security doesn't match their exposure. So because the thing is that deal might be 18 months. That deal might take 2 years. So basically for 80% of that journey, really until you've completed it, they are sitting there exposed, which the truth is that's the risky part. Once you get to the end and the value's been generated, yeah, agreed. There's limited risk there, but through that period there, that's when you're actually running the project, that's when the project is at its highest level of risk, and they are exposed under that arrangement. What else? What could you do? How could you appease that investor? Or what is another way that it could be cut so that their security is adequate? I know this is challenging you guys, but this is good. Like this is real. These are real conversations. If you actually go do some deals, these are real conversations you're going to have to have. So it's better to kind of figure this out with me now. They get 2/3. Yeah, well, it's closer. Okay, they're at 600,000 worth of security for 800,000 of debt. Solicitor's still going to say no. Now, again, I'm not saying you might not talk them across the line, but you will get absolutely you'll get it. And again, with limited track record, early days, it's a little bit more challenging there. You've got less to lean on. You're kind of literally going, trust me, as they are the serviceability partner and cash partner. Yep. And without getting too caught up on structures and the flow of money and all those sorts of things, security doesn't necessarily have to equal the same profit share. So, as an example, you can give them 100% ownership of the entity. That doesn't mean they get 100% ownership of the profit. So the two are not 100% linked. So they're actually separate questions. Is what are you giving them as security does not dictate how much they get for profit. All right, come on. What else? What's another possibility? How are we getting this investor on board? They love the investor. They like you, but currently there is an issue with security. You're not offering them security that they can sign off on. And notice that the other side of this coin is what security are you comfortable with? So you obviously want to protect your profit, and you obviously want to protect your ability to control the deal. They So you're kind of going into it with nothing cash wise or fiscal. You're starting at zero, you're adding value with your expertise and your time. They are coming into it with asset or the debt, which is in a way still an asset to the project. So they're going, look, I'm trusting you with this. How are you making sure that I get it back? What if you get hit by a bus tomorrow? That's the other thing too. There's the deal and there's you, but what happens if you get hit by a bus? All right, so I'm going to push this conversation forward a little bit because I can see we've kind of hit a bit of a blockage here. So one alternative is that, okay, well, it could be a case of, all right, well, you're 80% of the debt. You're 80% debt on the project, so we give you 80% shareholding. Could be 100% shareholding, could be 80% shareholding, whatever it might be there. Do you offer your house as security? I really have no clue. Hey, good on you for own that. Good. Look, you could do that. I wouldn't recommend it. Look, this is something where you've got to do your own money rules, and I will admit that early days in your first deals when you're trying to get money partners across the line, there may be things that you need to agree to there that later on you won't agree to anymore, just so you actually get that track record happening. For me, it's a hard no about my home. Um, I guess I do have the luxury of being able to say that now, but look, you can make that call for yourself. For me personally, I'd be more willing to lose profit out of a deal than sacrifice my home. So what I mean by that is, for me personally, I would prefer to give them a higher level of security in the entity, whether that be 80% shareholding, 100% shareholding, and have my interest in the project secured by the joint venture agreement. Now, that's a trade-off. Don't get me wrong, there is no perfect solution here. And this is one of the things to get is it is always a question of where does the pendulum sit and where are you comfortable? Because doing it that way, here's the pros and cons. Let's just go to the extreme. Let's say I give them 100% shareholding and they're the director when they go and get the finance. Now, two things. One, they need to be the sole director when they go for finance. There's nothing stopping you from becoming a director or even the sole director once finance is approved. So that is a way of getting your control. Noting that if they are the majority shareholder, automatic would be that they can overthrow a director and appoint themselves as the director. So there is that element of it. The other part being is, okay, if your interests are being managed by a share joint venture agreement or a development management agreement or something like that, the thing to note is the risk associated with that is that it is a reactive agreement. It's not what I would call a proactive agreement. Now, what do I mean by that? If you are set up in a structure that is, I guess, proactive, so let's say I have the title, well, the other joint venture partner can kick and scream all they want. If I have the title, I'm the one that has the strike of the pen and the power to do everything. So if they wanted to do something dodgy with the entity, they can't, because I am in control. I have the title, I have the directorship, I have the shareholding. So they actually can't. That's what I would call proactive. Reactive is if they have the directorship and they have the title and they have the shareholding, there's little I can do in real time if they decided to be, to be dodgy. There's little I can do in real time to actually stop them. It's more a case of then me waving around after the fact the joint venture agreement and going, you breached our agreement, I'm suing you. The thing is, they've already had the ability to do the bad stuff, and now I'm just trying to get my money back, as opposed to if I'm in control, they can't do it in the first place. So there's that trade-off. Now, you might go straight, well, that's the one I want. Got it, but it's also the one they want. And if they're the one putting in the money, then how are you getting them to agree to put in their money without security? So it's a trade-off there for both of you, is where are you willing to sit? Now, like I said, for me, I'm more willing to give up potential profit, as in, like, if I had a partner that turned dodgy, okay, I might be walking away for some profit, but I haven't put my home at risk. I can always make more profit. Okay, that's my personal perspective. That's not me telling you what to do. My other thing too is, which you might call me too trusting here, but I'm very careful actually who I go into business with. Now, that's not to say I might get it wrong sometimes. So far I've never had a partnership or anything go bad, touch wood. But my view of it has always been, if I always over deliver, if I always add more value than is expected of me, if a person is short-sighted enough to try and rip me off, the greatest punishment for them is they're never going to get another deal from me. Now, some people would go, mate, that's not enough. I want to protect every dollar of profit, blah, 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 blah. Okay, everyone's got to make their own call there. But so look, I've done these in all different ways. I've got deals where, and the thing is, every one of them is slightly different. There are ones where I have 100% ownership. There are ones where I have 50% ownership. There are ones where I have 0% ownership. And then there's different agreements to mix these all around. Like I said, there's no perfect one size fits all. It's a thing for every deal. But okay, let's go with this one. Let's move on from the debt and go, all right, so we're getting the debt by getting a joint venture partner, and that's going to have a joint venture agreement. Let's say they're going to have 100% ownership of the entity, and they will be director when they go for finance. But we have an agreement in place that once the finance is in place, that I then, you then go back on as the director, which many will actually like that from a practicability perspective, because if they are the director, they still need to be the one to sign everything all the way through the deal and all that sort of stuff. So it's a bit of an administrative thing. So for a person to be a true passive partner and just go, parking my money there, get me a return, they kind of need you to be the director. So that's a bit of a sale on that point, is it actually makes their life easier. Okay, so that's how we're going to get the debt. What about the cash? So we still need $500,000 in cash, 20% for the deposit, and $300,000 for the closing and the development costs and all the rest of it. How are we getting that cash? It could be the same person. So one answer is that it could be tied up in that joint venture agreement, and the other option is it could be coming from a different person. Okay, so let's look at the example of it's coming from the same person. All right, well, now it raises the same question. They're going, well, hang on a minute. I own the property, but the property's only worth $1 million now, and you want me to give you another $500,000? So now I'm exposed $1.3 million, and I've only got $1 million worth of debt. Right now, some of you are going, oh, for God's sake, didn't we just have this conversation? Welcome to the real world, in that there is always a conversation around the alignment of your security and when their money comes in. Now, when you get investors and you build trust, you will get investors that will be happy to go, yep, okay, understand. Here's the money up front. And as you build up your reputation and your track record, that's typically what you end up doing, is you're going, look, I've got the track record, people start getting attracted to you, and you go, look, this is how it needs to be. Because for me as the developer, I need to know that you've got the money. It's one thing for you to say it, but even if you have it when we start, what if you go and do something silly and go to the casino and throw it on black and red comes up? So I need to know the money's there for the deal so the deal doesn't get stuck. So later on, that might be the case if it's like, no, money's got to be in the bank right at the start. This is your first deal, so you maybe don't have that swing yet. So how are you dealing with that? When is the money coming in? Is it all coming at once? How would you deal with that? I can hear the cogs of the brains doing this, which is good. That means you're actually challenging yourself, and this is where the real learning happens. So, cash, when's it coming in? How are we dealing with that security issue there? If that investor is not willing to just go, sure, here's $500,000. I understand it's unsecured at the start, and I get my security later, right about the time when you're about to give me the money back. So, how are we dealing with that cash? Come on, guys, what do you got for me? How are we dealing with the cash? Couldn't you get another person to lend the money and get a percentage? Yep, but again, what's their security? You know, it's not a question of their profit return. Like, yep, you could provide them a coupon rate, like an interest rate, fixed 12%, 15%, whatever the heck it is, or it could be a percentage of the profit. But what's their security? If they're handing you over that money, how do they know they're getting it back? Because remember, the feasibility only really becomes true at the very end of the project, like when you get titles. A profit doesn't exist before that. So if they don't have security, they're basically exposed all through that time. Now, I'm not saying that some people won't agree to that, but I'm challenging you with the questions that you will be asked. And you'll find that every investor is slightly different in this space, particularly on your first deal. Some of my investors that have been with me the longest, that we now have the trust where, you know, if I asked, they'd probably just drop money into an account and do paperwork later. But that's taken years to build that trust. And how's that trust been built? It's by me honoring the spirit of the agreement over and over again, regardless of what the print says. They know their money is coming back. Not just because I say, but because I've had to make hard decisions in the past where I took I got the hit. Tick, tick, tick. Remember, it's okay to say you don't know and you get stuck. That's perfectly fine. So, one option would be to stage it. Having friends or family who trust you. Yeah, possible. They might still ask the same question. Um, and it opens up another question of your position on doing deals with family and friends. There's no right or wrong answer. It's just the usual thing. There's a risk and there's a reward. So one possible thing is staging the money coming in. So staging the money that comes in alignment with the work that's happening on the project. So in effect, as you do more work to the site, the value of the site goes up, so as does the security. So instead of it being $500,000 at the front, it might be, okay, it's the $200,000 for the deposit. It's obviously the $800,000 in debt coming at the time. The purchase price was $1 million. Okay, well, we need some capital to then start doing the work. So it might be like another 100 grand coming in at the start. And then at certain milestones, more money coming in. And there are other options, not one I personally like, but other options are that that they actually pay the invoices. So instead of you controlling the money, that the invoices get sent to them and they pay them. Now again, that then is you trusting them a lot more for the fact that they will pay, that they have the money, and that they'll pay on time. Personally, I don't love that option because one of the things is my reputation with my contractors and the other people out in the industry is that they get paid on time, if not early. So to put my name on it, but give someone else that control, there's a risk associated with that. But yeah, one option is to stage the flow of the money coming in so that it stays more in alignment as the value is added to the project. Okay, so yep, and with that, look, that could be the joint venture partner. And look, a very common thing when you start out is a 50-50 arrangement, someone that funds the whole thing, you run it, you find it, you do it all. They're just a passive partner and you get a 50-50 profit share at the end and they provide everything. If it's not that, yep, you might have a debt partner. They're definitely going to have to be on the title somehow. And as the debt partner, okay, how they're being remunerated. Now, I'm just mindful of the time now, so I'm going to start pushing through a few more answers through. But so they could be remunerated as a percentage of profit. I've also seen it done. Haven't done this myself, but it's an option. Is that they get paid a surplus over what the interest cost is. So let's say they've managed to get an 80% loan from Commonwealth Bank. The interest rate is 6%, and they might get paid 9% or 10% on that money. So that's enough to cover the 6%, and then they get the difference. That's another option as well. Then with your cash, same thing. If it's a joint venture partner and it's tied in with the debt, probably a profit share overall. If it's not, if it's a cash partner, then yeah, it could be a coupon rate. Typically, when it's the cash component, it's a coupon rate. You don't, they've kind of got the lower end of the risk in a sense there, and it's typically they get paid an interest rate if it's a separate cash person. Now, I'll throw another cat amongst the pigeons. If it is a debt partner and it's a separate cash partner, what security can you offer the cash partner? Because the bank's going to have first mortgage. Most first tier banks won't allow you to have a second mortgage registered. So what security are you going to give the cash partner? And just again, mindful of the time here. Well, what's a coupon rate? An interest rate, so a fixed rate. So you get a coupon rate from the bank when they say, "Hey, put it in this interest-bearing account, and we'll pay you 4%." That's a coupon rate. So if I say, "Okay, yep, if you lend me the money, I'll give you a 12% interest rate, 12% per annum, typically, simple interest, and that could be paid monthly, could be paid weekly, could be paid quarterly, could be paid annually, could be paid at the end, all up for discussion." So in terms of security, that can be a challenge if it's with the first tier bank, because often they will not want a registered second mortgage. So an unregistered second mortgage is an option, less favorable to investors. So then again, more trust comes in. Another option there is that it is all pre-signed and held in trust by a solicitor. And the agreement might state that in the event of a breach, that they can bring evidence of that breach to the solicitor, and the solicitor will lodge the second mortgage. It's going to cause issues with your first tier lender, but at that point, there's issues anyway. Back to the structures. If in a unit trust, give them a smaller unit than the other main investors. Yeah. It starts getting a little bit messy there for a smaller project. But look, there might maybe. So where were we? So we've got the debt, cash. Yep. So typically interest rate, but yes, second mortgage can be a challenge. So if it's going to be a second mortgage, often it'll be an unregistered second mortgage. And that can take a bit of working through, because again, solicitors aren't in love with that idea, because solicitors always want the gold standard of everything. But for everything, there is a risk and a reward. There is a pendulum swing. There will be exactly what their solicitor wants. There will be exactly what your solicitor wants. And if you leave it at that, there is never, ever going to be a deal done. So here's the reality: is most solicitors are deal killers, because they do not apply a commercial mind to it. They are only looking at how can they limit your risk? How can they reduce your risk? Well, the answer to how do you have the best risk strategy is don't do a deal. And they are quite happy with you making that decision. Other solicitors are also very happy to just keep pointing out problems and risks without offering solutions, because it's a great way to drum up fees. I have had agreements drag out for months and months and months, because this other solicitor, all they did, and very systematically, they didn't table it all at the beginning, was just every time a new revision was sent back, they go, "Oh, but blah, 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 here's a risk. What's your proposed solution?" They never gave one because they weren't interested in finding a solution. They weren't interested in wrapping things up. They just wanted to drag on fees. So be mindful of that with solicitors. Is you need a solicitor that is actually looking to get an outcome for you, and you need to be clear with them. Is like, I want this deal to be done. So help me find a way to do the deal in a way that manages my risk appropriately. And at some point, you are going to have to go, I'm okay with that risk. There's no risk-free situation. It's always a trade-off. So just be aware of that, and be aware of that with the solicitor that your partners choose. I won't mention names, but there are specific solicitors that I will not enter into negotiations if my partner on the other side is using that solicitor. Why? Because I know exactly how they operate, and they have absolute, number one, they're somewhat incompetent, but number two, they have no interest in wrapping things up. They have every interest in having it roll and roll and roll and roll. And then an agreement that should cost maybe $3,000 ends up costing you 10 to 15,000. Real case, real situation. So we are going to start wrapping things up because, my goodness, we've almost ticked off an hour there. But has this been valuable? Have you got value out of doing this workshop situation? I know it's been hard, but has it been valuable? Oops, my comments have just scrolled. Why has that happened? Here we go. And if it has, which I hope it has, I expect it has, what have been the key takeaways for you? Because, yeah, like I said, these are the real conversations you are going to have. These are the real things, not the stuff that's put up on a whiteboard or on the slides or whatever when you go to the events. This is typically not done. Why? It's not the most exciting stuff to talk about, but this is the real stuff that you actually need to be able to do. And all of this comes back to, if you are a person of integrity and you have a reputation of being that, then people are going to listen to you, and people are going to want to work with you, and you are going to have the ability to influence the outcome more. So that's number one. Number two is be a person that people want to do business with and treat other people the same way. Again, if you are a person that people want to work with, they will want to find a solution with you as opposed to rely on the agreement. I've not once pulled out an agreement with any of my partners, because ultimately, if you've pulled out the agreement once it's been signed, things are already in trouble. So you want to be doing deals with people that you can trust. Yes, you do the agreement. The agreement gets done. It's just being commercially responsible. But one of the good things, and probably the best thing about the agreement, is having these discussions at the beginning before there is emotions involved, before there is anything at stake. Because if you think it's hard having these conversations and working through these things at the beginning when there is no money on the table, it gets much harder as soon as money is on the table, because then you've got emotions. Then you've got something at stake. So this can actually be one of your biggest learning curves, is learning opportunities, is doing your first joint venture agreement and negotiating your first loan agreements. Because then you start to understand, what's really important to the other side, and how can you influence that situation, and how can you come to a situation where both parties are happy. How make the deal work with the investor? In terms of what's been valuable, how to make the deal work with the investor. And look, this is just scratching the surface. Okay, don't expect to become an expert in it overnight. This is something that I've been, getting better and better at. Because I'm not even going to call myself an expert relative to most people. Sure, I am, but there's always going to be people that are better. The people that I'm learning from are negotiating deals that are worth hundreds of millions and billions. So relative to them, what do I know? But I have learned a lot over the past 10 years. I have done a lot of deals over the past 10 years. And like I said at the beginning, the reason I wanted to do this with you today was because I have always known, I shouldn't say I've always known, I've known for a long time, but it's becoming more apparent to me even more recently. And also looking at the people that I'm learning from that are doing things much, 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 much bigger than me, is how have they done it? How have they done the biggest deals they've done? Well, I can tell you what, they didn't have the money to do it themselves. So if you look at anyone, the biggest deals that have been done, very, 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 very rarely was it done with their own money. It is always finding an opportunity, finding someone with the resources, and you being the person that puts these things together. Okay, so you've got to craft your ability to find the opportunities, and you've got to craft your ability to influence and do business with people that have the resources. Because when you can combine those things together, there's no limit. There's zero limit. All right, That's us done for the day, guys. Good effort. I know that was some heavy lifting today, more so than we usually do in these sessions, but I think that was definitely really valuable for you. And without a doubt, this skill of learning to raise capital is probably the most important of all, because if you can do that, when you get a cracking opportunity. And the thing is, don't limit yourself to thinking, oh, I only need to raise 50,000, or I only need to raise 100,000. What if I came to you tomorrow and went, hey, there's a deal here that can make you 10 million bucks? There's a deal. I need, it's ready. It needs to go. It needs funding. Okay. How are you funding it? Right? That could be your future. That could happen to you. So prepare for it. All right. That's us done, guys. Great work. Well done. And I will see you next week.